It's been an exciting year for equity investors, not to mention, though, that they have had their fair share of dealings in terms of geopolitical crisis, central banks that refuse to budge from those elevated interest rate levels. What's in store for 2024? And more importantly, how are investors perceiving the outlook for Indian equities? I have with me Nitin, Jain, the CEO and Principal Investment Manager with Kotak International Funds. Let's start by talking about India. Many are calling India as being in a Goldilocks scenario where interest rates are neither too high nor too low. The growth outlook, again, is neither too high, neither too low. What's your take? Do you agree with this assessment?
Thanks, Mabina. You summed it pretty well. Before I come to the Goldilocks question, let me just recap the last 3 years because it will set the parameters for what is going to happen in the next few years, and for India also in particular. So when you think about it, in the last 3 years, we have seen it all. What we see in decades, we have seen it play out in just last 3 years. We saw COVID, and COVID resulted in significant disruptions across the world. In a response to COVID, we saw big monetary and fiscal stimulus by every government. It was a very uneven recovery. In that recovery, in that path of COVID hitting us, and in that recovery, we saw oil going from $20 at the low to almost $140, and then back to 75 level as we speak. We saw inflation, touching almost 8-9% in the developed markets, which was unprecedented. The supply shocks, the geopolitical risk got heightened in between. So all of this was something that was unprecedented in a very short time. Then we saw a Fed response. The Fed response to the inflation problem was again very unprecedented. For almost no interest rate, we went to a steep cliff of interest rate as we speak. So, when we think about the world economy as we speak, the world economy is coming out of post-COVID shocks, the supply shocks. The world is coming out of it, but it is still very uneven. In that backdrop, India looks to have done pretty well. Yes, we did suffer initially in the COVID shock, but since then we have come back very strongly. When I look at India on multiple parameters, be it on macro parameters or in the companies, from what they are delivering, what the outlook is, it looks to be a very strong outlook in the near future. Now, let me just sum it up, in some of the parameters. India is an emerging market. Now, emerging markets can get hit by some event which is local or global, and the impact of those events is quite large. And it can be a small event somewhere else, but it can lead to a shock in the emerging market. Now, we have seen that in past. Energy crisis has hit India particularly bad in past. When I look at things now, inflation, as you rightly said, India inflation is not too low, not too high, just the right number of inflation within the central bank range of 4% plus minus 2%. The oil prices have gone up, have moderated. India has absorbed all those oil prices well. The geopolitical risks, India is placed well, at this point of time on the geopolitical side. The supply chain rebalancing, India is pretty well, placed. China will obviously look to give up some market share in the supply chain rebalancing. India will look to benefit from some of that. But more importantly, when you look at domestic factors, the investment cycle, the investment cycle is looking to pick up. We have seen that the government spending has been reasonably strong on the infrastructure side. We now see household spending and real estate coming back. We do expect the corporate cycle to pick up. When we look at banking sector, the banking sector health is very strong at this point of time. The balance sheets are adequately capitalized. The stress asset is very low. So a lot of things are working in India's favor as we speak. On the corporate side, we see earnings cycle being very strong. We have seen significant rise in commodity prices, which did impact some of the earnings. But despite that, when you think about it, in the last 4 years, from 2021 to March 2024, we would expect that earnings will double, from a corporate perspective. So yes, a lot of things are going right. But to say it's a Goldilocks scenario, maybe it's not so correct. We still have some uneven growth in India. The urban recovery is very strong. The rural recovery is still patchy. The investment cycle is yet to pick up in the corporate side. There are some worries, from a overall mass consumption perspective. So it is a good, phase of our growth, but it's not yet a Goldilocks scenario, but there is very visible pathway to that scenario in the next couple of years.
So considering all of these factors, what do you think will be the India growth outlook versus rest of the world and versus the rest of the emerging economies as well?
So if you look at the last 30, 40 years, India has been growing at a differential rate to global economy. The only large economy which has outgrown India in the last 30, 40 years has been China. It is an economic miracle. It is a very large economy, but even that is slowing down. When I look at the next, in the current decade, in the next 6, 7 years, as per various estimates, India is looking to grow at around 6.5%, which is a moderate growth. We are not building very high growth, but that 6.5% means that India's growth will be good 300 basis point higher than global growth. That also means that India will outgrow China by around 200 basis point for the next few years. So India's relative growth is looking to be very strong. Think of it, in year 2000, India was not part of top 10 global GDPs. Today, we are in the fifth spot of global GDP. And by the end of the decade, it is expected that India will become the third largest GDP. So that is an incredible journey in the last 30 years from not being part of top 10 to becoming the third largest GDP by 2030. That also means, India is today, we know it, India is today, at the lower end of per capita income. We are not a rich nation. We have $2,500 of per capita income. But by the end of the decade, we should hopefully be going towards $5,000 plus of per capita income if we sustain 6.5% growth rate over the next few years. So it's looking to be a good growth from here on till the end of the decade. And that's what we are hoping that we will play out.
Many are looking at India as a country that can perhaps give the kind of returns that China did back in the early 2000s. We are at the cusp of achieving many new milestones. Would you agree with that assessment, especially because we are seeing, proof of that on ground? Apple being the biggest example, it's shifted a chunk of its production to India. So do you see India as being at that cusp of, economic expansion the way China was in the early 2000s?
When you think about China's economic growth has been very rapid, very fast, and it has been at times created wealth for investors. At times it has not created wealth for investors. So China business model has been very different than in what India is looking to follow. In many ways, we would like to sustain that high growth that China did. No, it did very high growth for almost 2 decades. So we would like to emulate China on that front. But we will also like to reward investors in that journey. When you think about it, last decade, China grew faster than India, but the investors had a zero return. In the same time horizon, Indian investors had more than doubled their money, in US dollars. So India has been giving a very strong return. Going back to the first decade of this, 2000 to 2010. Now, I think India and China did pretty well. Both of them did pretty well before we got hit by the financial crisis. Now, do remember from 2003 to 2008, India was the best performing market with a GDP growth of around 8%. If we can replicate that kind of growth, maybe we can replicate that kind of earnings growth for corporates too. No, that will be a cycle that we will look to repeat. And that is where we are looking, in the next few years, that India is now looking at a differentiated growth path as compared to rest of the world. So again, we will look to follow China in its economic growth, but reward investors alongside.
Let's focus a little bit on China. It was the only major equity market that underperformed and gave a negative return. There was a property crisis and investors questioning the financial stability of the country. But considering this underperformance, it's also a little undervalued vis-a-vis the rest of the world. Do you see China give us a positive surprise in the years to come?
So it's very difficult to make assessment about Chinese economy because there are a lot of data points in China which are still very opaque. India. The good thing about India is that our data is very transparent. And our auditors are global auditors. The lack of data in China makes the outcome a little uncertain. Of course, the real estate sector problems in China are very well known. I don't think that there's a threat of financial stability there, but the worries on the big sector in China, the real estate sector, are very well known. Now, it has done relatively poorly in 2023. Look at US. US markets delivered, the Nasdaq delivered more than 40% return last year. So on a relative basis, China has underperformed quite massively. in 2023. So there's obviously a case for a bounce back. But I would rather focus on medium term than near term. So near term bounce backs in many economies is possible. Near term consolidation in Indian market is possible. Indian market did reasonably well over the last 2 years. We can see some consolidation in the near term. But if I look at medium term at this point of time, our view is India has many things going right for it. China has a lot of uncertainty at this point of time. Policy uncertainty in China is pretty high. So I think some of those factors will weigh on investor sentiment from a medium term perspective. Short term, one cannot rule out a strong bounce there.
All right, then keeping it with valuations, considering that India has actually run up quite a bit, would you be a bit perturbed about what the valuations are at currently for India?
When you think about valuations and when you think about medium term and long term, it's the corporate earnings cycle which determines the longer term journey. At this point of time, we are coming off from a weak corporate earnings cycle in the past decade to a reasonably strong corporate earnings cycle from here on. As I mentioned earlier, the banks are in a very good state of capital adequacy and asset quality. They are going to be providers of capital for growth, which they were not in the last decade. The household sector is looking to come back in the form of real estate cycle. This cycle was very weak cycle in the past 1 decade. It is just started to come up, and real estate cycles are long. So it's a very contrasting cycle in India. Globally, real estate is under stress. India real estate is seeing a new cycle as we speak. The corporate capex cycle has been weak in the last 1 decade. Now we see capacity utilization actually moving above long-term averages. So we see that coming in. India is trying to build, a big manufacturing base. We have been very successful in services. We are the pharmacy of the world, but we are not a manufacturing hub for the rest of the world. We talked about supply chain rebalancing. There is also an effort for India making for itself, and then using that strong base for make for the world. You mentioned Apple. Of course, Apple is now looking to build a lot of its requirements from India. It's looking to reshore some of its facilities from China into India. So I think from a medium-term perspective, the earning cycle is looking reasonably strong. The return on equity is looking to be reasonably good as we speak. All of those make us pretty much comfortable from an investment perspective, despite a slightly higher level of valuation that we see as we speak. Now, if you think about it, in the last 10 years, our market multiple has been around 20 times on an average, 20 times on an average for the last 10 years, without any strong earnings or return on equity. In the last 2 years, we have seen a very strong earnings, and the next 2 years, we see a reasonable growth in earnings and a recovery of return on equity to a very healthy levels of around 16-17% over the next 2 years. So we are at 19.5 multiple 1 year forward. So we are at a similar or lower multiple as compared to last 10 years, but our earning cycle is looking to be much better. Of course, there are sub-segments within the market. The mid-market is trading at a premium to the large cap market. So one can see a little bit of consolidation there and there. But again, I'm reiterating, on a medium-term basis, the mid-market segment of the Indian economy is having a very strong runway for growth. Let me elaborate that a bit. When you think about per capita income moving from $2,500 to $5,000, a lot of this increased per capita income will go towards consumer discretionary spending. And where are the consumer discretionary leaders sitting? The leadership of consumer discretionary businesses in India is in the mid-market business. If India is looking to make in India, where are companies? Mostly the industrial companies, the manufacturing companies are in the mid-market bucket. So there is a very strong tailwind for mid-market companies. Yes, the valuation may look a tad expensive, but the long-term earning growth cycle in there is very, very strong. So at this point of time, we believe that the valuation in India is at a level where we don't expect valuation to expand further, but earnings growth is going to be pretty strong, and Indian investors, global investors, will look to capture that earnings growth over the next few years. The other element to it is obviously flows. All strong markets need strong flows. It is very interesting when you think about it. In the last 3 years, if I were to just take out December of 2023, we saw some money coming from global investors. But let me take that out for a moment. CY21, CY22, CY23 till November, the total amount of money coming from foreign investors into India, the sum total money in the last 3 years was zero. Exactly zero. India, which was the most favored market from global investors, did not see any money coming from them. And in the same time horizon, India's weight in MSCI emerging market doubled from 8% to almost 16%. It is the domestic investors which have been putting money to work in India. The assets, from India perspective, India household perspective is moving from fixed income gold towards slight risk-taking equity assets. Now, as we speak, we are seeing $2 billion a month coming from small retail investors, what we call in India as systematic investment plans or dollar cost averaging as it's known globally. And that's $24 billion a year and growing. In addition, there is money coming from pension money, insurance money. I think the tailwind of flows is not something that one can ignore. And domestic money, importantly, is also more democratic. What do I mean by that? Global money is typically very ETF focused, very large cap focused. But domestic money goes into large cap companies, mid cap companies, small cap companies. So it is helping the mid cap and small cap also gain some momentum because money is coming in those segments of the market. So I would tend to believe that, yes, on a relative basis, India's valuation also looks expensive because China is not doing well. It's not as if India is not done very, very well. So on a relative basis, yes, we are expensive, but on its own, India is slightly above long-term valuation, but the earning cycle is very strong, return on equity is very strong, and flows are supportive.
All right. So essentially, the valuation premium that India is trading at right now, it is something that's deservedly so. Let's talk about a big event that's going to take place in 2024 that's going to be watched for by not just India but the rest of the world as well, and that's the general elections. In the run-up to the elections, usually we've seen a lot of positive momentum in the equity markets. What sort of opportunities do you see this year bring up for equity investors in India?
So 2024 is going to be a very interesting year from a political perspective. It's not only India, but there is going to be a multiple other large economies which are going to go through an election phase this year. So there's going to be a lot of uncertainty in global investing because of election outcomes in various parts of the world. But from an India perspective, elections are due in the month of May. We had elections in some states in the month of November. The results were declared in the early part of December. The results of those state elections were very favorable for the ruling party. Mr. Modi's led BJP surprised everyone by getting the key states. And that reinforces our view that in the federal election in the month of May this year, there's a very strong possibility of a political continuity. That means policy continuity. So in a world which is facing uncertain policy and political outcomes, India offers to investors 5.5 years of political and policy stability. Now, the next term will be a 5-year term. When I look at 2024, it looks to be a very interesting year from an investment cycle perspective too. Pre-election, there could be some elevated spending. Indian rural economy is not really firing at this point of time. A little bit of support to the rural economy can, lead to buoyancy there too.
Okay, and finally, just to wrap things up then, it's pretty clear that you are quite bullish on India. So for those investors who are looking to invest in India, what are the themes you'd recommend?
Other than financial sector, we are focusing on consumer discretionary theme. We are focusing on the Make in India, the entire investment cycle theme in India. We are focusing on the real estate cycle side of India. From a little bit of a conservative stance, we are also looking to have an overweight in healthcare and pharmaceutical space in our portfolios, where we are taking off money. We took off some money from financials. We are underweight energy. We are ESG investors. We are very conscious investors on ESG. So we are underweight on utilities. We are underweight on global cyclicals. Energy is also underweight because of that. So these are some sectors that we are underweight from our portfolio positioning perspective. But we remain very positive from a medium-term perspective. At this point in time, valuation and other consideration are making us underweight these sectors.
Well, India clearly has a long way to go from here. That was Nitin Jain speaking about how he's looking at India and what are the key themes that you should look at when investing in the country.